Hey everyone, welcome back to Corporate Decoder, the place where we unwrap the financial mysteries of big corporations, and today we're diving deep into the latest quarterly report from IIOT-OXYS Incorporated. Prepare yourselves, because this one's got more twists and turns than a scavenger hunt designed by a tax lawyer. Alright, straight out of the gate, this is their quarterly report, sort of like a financial checkup every 3 months. Think of it as a snapshot of how the company is doing right now, focusing on the period ending the 30th of September 2025. Now, the company we are looking at is IIOT-OXYS Incorporated. And as you can see from the financials, they have a couple of subsidiaries, OXYS Corporation and HereLab Incorporated. This means the numbers you see reflect the performance of not just the parent company, but also these other entities it owns. Let us slide right into the balance sheet. If you imagine the company as a person, this is like their wallet and their belongings on a specific day. We're looking at the 30th of September 2025 and comparing it to the end of 2024. First, cash. Remember that pile of cash in your wallet? Well, for IIOT-OXYS Incorporated, it is shrunk quite a bit. As of the 30th of September 2025, they had just $278 in cash and cash equivalents. Compare that to $23,593 at the end of 2024. That is not a typo, folks. That is a dramatic drop. It is like going from a full piggy bank to just a few loose coins. Now, let's talk about what the company owes to others, their short-term debts. These are called current liabilities. As of the 30th of September 2025, they had a total of $3,190,356 in current liabilities. That is up from $2,503,160 at the end of 2024. This means their immediate bills and debts have grown significantly. Taking a bigger picture view, their total liabilities, which include both short-term and long-term debts, stand at $3,191,356 on the 30th of September 2025. This is up from $2,759,160 at the end of 2024. So definitely an increase in what the company owes. Here is something interesting. They've issued Series D convertible preferred stock. This is a type of stock that can be turned into regular common stock. For Series D, they have 141 shares issued as of the 30th of September 2025, which represents a liquidation preference of $169,200. This is new compared to the 31st of December 2024, when they had 0 shares issued and thus 0 liquidation preference. This indicates a new round of financing or issuance involving this type of stock. Now for the stockholders' equity, which is essentially what is left over for the owners after all debts are paid. And here we see a deficit on the 30th of September 2025. The total stockholders' equity deficit was $4,015,852. This is a bit worse than the deficit of $3,347,179 at the end of 2024. A deficit means the company owes more than it owns, at least from the perspective of its equity holders. Let's move on to the income statement for the 3 and 9 months ended the 30th of September 2025 and 2024. This tells us about the company's performance over a period of time, like its profit or loss. Starting with revenues, or the money the company actually made from selling things. For the 3 months ending the 30th of September 2025, and also for 2024, revenues were 0. For the 9 months ending the 30th of September 2025, revenues were also 0. Interestingly, in the 9 months ending the 30th of September 2024, they did have $2,500 in revenue, so this company is not exactly raking in the sales right now. Following revenues, we have gross profit, which is what is left after subtracting the direct cost of producing goods or services. For all periods shown except the 9 months ended the 30th of September 2024, where it was $375, the gross profit is 0. This makes sense if there are no revenues. Operating expenses include things like amortization. This is like spreading out the cost of an intangible asset, like intellectual property, over its useful life. For the 3 months ending the 30th of September 2025, amortization was $12,476, very similar to $12,477 in 2024. For the 9 months, it was $37,022 in 2025 compared to $37,159 in 2024. These numbers are pretty consistent. General and administrative expenses are the costs of running the company overall, like salaries and office costs. This was $87,557 for the 3 months ended the 30th of September 2025, down from $143,354 in the same period in 2024. For the 9 months, it was $276,242 in 2025. a slight decrease from $290,027 in 2024. Here is a big one. The gain or loss on the change in fair market value of derivative liability. These are complex financial instruments that can gain or lose value. For the 3 months ending the 30th of September, 2025, they had a loss of $375,481 here. In the same period of 2024, they actually had a gain of $63,503. For the 9 months, the loss in 2025 was $147,170, while in 2024 it was a loss of $282,623. The variability here really impacts the bottom line. When you add it all up for the 3 months ending the 30th of September 2025, the company had a net loss before income taxes of $408,388. In the same period last year, 2024, the loss was $104,676. For the 9 months ending the 30th of September 2025, the net loss before income taxes was $590,928 compared to $711,694 in 2024. And after preferred stock dividends, the net loss attributable to common stockholders for the 3 months ending the 30th of September 2025 was $438,889. For the same period in 2024, it was $126,199. For the 9 months ending the 30th of September 2025, the net loss was $669,613, and for 2024 it was $773,580. Essentially, the company is losing money and the losses, while fluctuating, remain substantial. This leads to earnings per S-share. Since they have losses, it is a loss per S-share. For both the 3 and 9 month periods in 2025 and 2024, the net loss per S-share is reported as $0. This is because the loss is so small per S-share when considering the massive number of shares outstanding. Now let's look at the statement of stockholders' equity. This table shows how the equity section of the balance sheet changes over time. We start with the balance at the 31st of December 2024, showing a deficit of $3,347,179. Then we see common stock issued to related parties for services. This means they issued stock in exchange for work done by people connected to the company. This added $11,000 in value and 11,000,000 shares. The net loss for the 9 months ending the 30th of September 2025 was $669,613, which further increased the deficit. By the 30th of September 2025, the equity deficit grew to $4,015,852. This confirms that the company's liabilities are significantly higher than its assets, and it is not a good sign for the owners. Moving on to the cash flow statement, this tracks all the cash coming in and going out of the company. Again, we see the net loss here. For the 9 months ended the 30th of September 2025, it was $669,613, and for 2024, it was $773,580. The most crucial part for a company's health is often its operating activities. For the 9 months ended the 30th of September 2025, the company used $159,135 in cash from operations. This is an improvement from the $15,063 used in the same period of 2024, meaning they are using less cash to run the business. But they are still using cash, not generating it. On the financing side, which is how companies raise money through debt or selling stock, they provided $135,820 in cash in the 9 months of 2025. This came from selling preferred stock and some overdraft proceeds, offset by offering costs. In 2024, they provided $17,600. The net result of all this is a decrease in cash. For the 9 months ended the 30th of September 2025, cash decreased by $23,315, ending up at just $278. In 2024, there was a small increase of $2,537, ending at $3,181. The company is burning through its cash at an alarming rate. Now, this is where things get really critical. Under the going concern section, management states that the company has suffered continuous operating losses, has a working capital deficit of over $3 million, and a net loss for the 9 months of nearly $670,000. These factors, they say, raise substantial doubt about the company's ability to continue as a going concern. This is the big one, folks. It means the company's survival is in question and they might not be able to pay their debts. This note discusses how the company accounts for things. It mentions revenue recognition following specific accounting rules, like ASC topic number 6, 106, which is about how companies report income from contracts. Here they detail their intangible assets, which are things like patents and intellectual property. As of the 30th of September 2025, these net intangible assets were valued at $112,426. This is down from $149,449 at the end of 2024. They also list the future amortization expenses for these assets. This section covers future obligations and potential problems. They talk about consulting agreements with directors and officers and stock incentive plans. There are details about shares issued and unissued under various plans like the 2017, 2019, and 2022 stock incentive plans. There is also information about the CEO's employment agreement with potential salary increases based on sales targets and salaries payable to the CEO and QAP interim CFO. Let's hop over to the convertible notes payable. Note A is a significant one with a principal balance of $205,000 still outstanding. It is secured by substantially all the company's assets, meaning if they can't pay, the lenders can take most of the company's belongings. Its maturity date has been extended multiple times, and it has very specific conditions for conversion and potential incentive shares. Similarly, Note D has a principal balance of $50,000 and is also secured by company assets and has extended maturity dates. Interest expense related to these notes is a recurring item. Note E, payable to a related party, has a principal balance of $125,000 and its maturity date was recently extended to February 2026. Note G is interesting because a significant portion was converted into common stock in early 2024. The principal balance remaining is $13,942, with its maturity date also extended. This is where we look at the earnings or losses on a per share basis. As mentioned earlier, due to the losses and the sheer number of shares, the basic and diluted net loss per S-share is reported as $0. This often happens when a company has many shares outstanding and is not highly profitable. They also list anti-dilutive common stock equivalents. These are potential shares that, if counted, would actually make the reported loss per S-share look better. Because it would make the loss per S-share smaller, they are excluded from diluted EPS calculations. The number here is staggering. Over 3 billion potential shares in 2025 and over 1.5 billion in 2024 that are considered anti-dilutive. This highlights the extreme potential dilution if these convert. This section details transactions with individuals or entities closely connected to the company, like officers, directors, or major shareholders. We see notes payable to officers and directors, and even advances for working capital from an officer. There is also a lease agreement with stockholders for office space. The company has a convertible note payable to a director and accrued interest on that note. Here we get into the details of their Series B convertible preferred stock financing. Issued multiple times between 2020 and 2024, this stock has some complex features. The company has been recording significant gains and losses related to the change in fair market value of derivative liabilities tied to these preferred stock issuances. For example, looking back at Note 18 for the 3 months ending the 30th of September 2025, they reported a loss of $70,384 related to this. These are volatile numbers that heavily impact profitability. Similarly, they detail their Series C convertible preferred stock, including its conversion features and dividends. Note 23 shows a debt exchange agreement where a convertible promissory note was converted into Series C preferred stock. Then we have the Series D convertible preferred stock authorized in March 2025. This also involves complex conversion features and has resulted in derivative liabilities. The company is actively issuing these preferred shares, as seen in the multiple issuances throughout 2025. This table shows the movement in the fair value of their derivative liabilities. As of the 30th of September 2025, the total fair value of these liabilities was $1,073,416, a significant increase from $758,787 at the end of 2024. This large and growing derivative liability is a major financial risk. The company also has warrants, which are like options to buy stock. The table here shows that all warrants that were outstanding at the end of 2023 and 2024 have either expired or been forfeited, meaning there are no outstanding warrants as of the 30th of September 2025. This is crucial. It covers important events that happened after the reporting period, but before the report was filed, on the 29th of October 2025, they extended a note maturity. Then, a major event on the 30th of October 2025, they designated a new class of stock, Series E convertible preferred stock. This means they are issuing more preferred stock with new terms. Also on the 30th of October 2025, a big deal happened. The IIOT-OXYS Incorporated entered into an agreement with GHS Investments LLC, a major investor, to issue them shares. This is a key development in the company's financing landscape. Even more significant, on the 30th of October 2025, they entered into debt exchange agreements to convert various accrued fees and debt owed to their CEO, former director, and former CFO into Series E convertible preferred stock. This is a significant restructuring of their debt and equity. Then trees an asset transfer agreement with a Spanish company, Angura II L, tied to fees owed to Angura. And get this, on the 5th of November 2025, the control of the company was transferred to GHS, their lead investor. This is a huge shift in leadership and ownership. The CEO will remain, but with a new board and new investors in control. The expectation is better access to capital and potentially mergers or acquisitions to boost shareholder value. Let's talk about what this all means. The most glaring fact here is the company's financial precariousness, with almost no cash on hand and a growing deficit, coupled with significant liabilities and a looming question about its ability to continue as a going concern. IIOT-OXYS Incorporated is in a very challenging position. The constant issuance of convertible preferred stock and the creation of derivative liabilities suggest a company that is actively seeking funding. But at a potentially high cost and with significant complexity, the fact that control has transferred to their lead investor, GHS, is a massive event. It signals a potential recapitalization or a strategic shift aimed at stabilizing the company and potentially finding a path to growth, perhaps through mergers or acquisitions. The company's strategy seems to revolve around the potential in smart manufacturing and structural health monitoring industries, but realizing that potential is heavily dependent on securing adequate funding, which has been a major hurdle. The sheer volume of convertible securities and the associated derivative liabilities are a big red flag indicating financial engineering rather than straightforward business growth. For investors, this situation is extremely high risk. The company is essentially betting on future growth and funding to overcome its current challenges, but the odds are stacked against it. Alright? That is our deep dive into IIOT-OXYS Incorporated's latest financial report. What are your thoughts on this company's future, especially after the control transfer? Let us know in the comments below if you found this breakdown helpful. Give this video a like and subscribe for more corporate financial deconstructions. And hey, don't forget to join our Discord community linked in the description for more insights and discussions. Thanks for watching, and we'll see you in the next one.